Hi everyone, welcome to Investing for Value. So I've got a stock under mine, Revolve Group, which came on to the market about 6 months ago. So when it came onto the market, the stock just went through the roof to $48. So it came on IPO about $18. So it's currently valuing at $20.69. So a little higher than the IPO value. But for this stock to get up to $48, well, there was a lot of hype into it. And the thing is, the company isn't exactly growing really quick. Like for a retailer, it's not doing too badly. Like if we're going to class it, in that sector and say how good is this doing compared to other retailers, because other retailers are not faring well. So this one's actually faring quite well. Growing at 22.8% or for the 3 month and 22% for the 9 month. So kind of this is giving you an idea how fast revenues are growing, and revenues don't generally grow that much quicker. Like generally companies grow bigger, the growth kind of slows down, and then I think this is what started to disappoint the market. So when net profits for the 9 month was only growing at 12%, and this one was growing at about 21.6%. So when your net profit's growing slower than your revenue, there's actually a bit of concern because generally, if your margins are good, your net profit should be growing a bit quicker than your revenue. So you have to consider that. So that's why when the market kind of looked at the stock and it was at $48, they were going, "Oh, actually, this isn't worth it," and the stock just shot downwards. So it ended up just around the $14 mark. So it's a far fetched from $48. So you might be looking at that and be going, is this a bargain or not? Like $48 was definitely a bit overhyped, overvalued, and that's normal with IPOs. There's always too much hype. So when we look at this and we go, okay, this is a reason why the stock shot downwards from 48. But since $14, it's kind of recovered to this $20 mark. So this is the last quarter that we've been given, and this is for the September quarter. So September quarter, 154 million in revenue for 3 months, lower than the prior quarter. And then the net profit was actually lower as well. So then their revenue is highly correlated for their net profit, and for the 9 months, it was 453 million, and as you can see, they're both growing about 22%. So you can see, like based on 2 quarters, 22% is going to be a pretty standard figure for this company. Though I do expect the December quarter to have done a bit more because of the Christmas period. Like Christmas tends to be a bit more busier, but would probably still go, it's going to be around that 22%, unless the company just spent a bit more money to just push more growth. And as you can see, this net profit went up 33.8%, but as you can see, it's a 9.5 million, so it's a lot less than this figure up here. So even though it's high, it's on a lower figure. And then if we look here, this kind of gives you a bit more it gives you a bit more realistic look at it, and go 27 million for the 9 months, and it was growing at 18.8% from the prior year. So when we consider this, we go, okay, so the net profits for the year is probably going to be looking at about 42 million. We're going to expect, I'm expecting around 15 million in net profit for the quarter that's just gone by. And I'm going to say 42 million net profit. So 42 million net profit on $1.4 billion company. That's about a PE of 33. So 33 is actually more on the high end. So I would say it's not exactly something that it's probably pricing this at a pretty fair value basis already. To say that there's upside, we can project it downwards to the next quarter, the next financial year, and we can go, if these guys were making 42 million and they're growing at about 22%. You know, like, give or minus with these figures, like if we average them, they're looking still around that 20% or 22%. So on a rough estimate, 22% net profit growth, we'll get about 51 million. So 51 million, and say this growth is going to slow down as they get a bit bigger. So, and we do it times a P of about 30, we get about a 1.5 billion valuation. So even at a P of 30, the valuation's actually still very close to there. So for me, I don't really see like a big upside for this company. Like, I like what they're doing. Like, they're obviously doing quite well, because out of, I think, 10 brands trending, they have 8 in there. So this company is obviously doing really well, and they're growing at 22%, which isn't like something that's, you know, it's not necessarily a low number, but it's not necessarily a high number either. So you kind of have to just do your work and go, okay, maybe this company is very consistent. Like, it's consistent, and it's going to be able to grow in a reasonable way, and it's establishing itself as a big player going forward. But the thing is, how much upside? Like, I don't see the upside being that much of an upside. Like, you might get about 20-30% return for the year, which might not be too bad from this $20 price tag. But that would be pricing the stock on the upside, and for me, like, I rather value a stock in more of a standard or conservative way before I buy. Like, as Warren Buffett says, buy at a margin of safety, so that things go wrong, and of course things always go wrong at one point or another. So at this kind of stage, at 22%, 1.4 billion for this company, and the net profits, unless something dramatically improves, like after December quarter was like way past 15 million in net profit, and the growth for the previous revenue was higher than 22%, they actually might give the market a bit more confidence into going, okay, this company's actually got a bit more growth behind it, with a bit more money from the IPO it's managed to. But this is from 6 months, and they already have the money in the bank. It's a matter of, you know, are they using the right strategy? If they're already using the right strategy, then I don't really see that much upside, unless they're possibly making an acquisition, though they may not, because they already have like 21 brands behind them. I don't imagine you need to grow, like, you just need to grow the distribution. And these guys are just online, so online is pretty set. Like, if you're in stores, you might just think, okay, we're going to grow into more stores. But if you're just online, I don't imagine you just grow into more websites or something like that. So I imagine, like, if people are buying your products, they just keep going to the same website, and that's kind of what's keeping the cost down for these guys. So the reason, you know, in clothing, margins tend to be quite slim, especially with this competitive environment where everyone's able to just buy online, compare pricing. So these guys are actually doing quite well for clothing, you know, online retailer. But for me, like, I tend to want to get into a stock where I see like 50% upside at least in 2 years. Like, if I'm not going to get 50% within 2 years, then I kind of don't feel like it's worth my time, because for me, like, I'm young and I want to take high risks, I want high returns, and there's a lot of stocks that just give much higher returns. I don't have to go for this one to get a high return, though. Like, but again, like, if you feel like this is a company that you're comfortable with, you understand, and you may want to invest into it, maybe invest a little bit. And you know, at the end of that, like, as I say, like, if you can get like 20% return for a year, maybe that's pretty good for you. Maybe you don't want to like risk it on like a company that's still expanding and losing a ton of money, because the good thing about this company is it's profitable. So it's pretty safe in terms of that category. But though you're gonna look at the risk of fashion, fashion can go out of favor. So have you ever heard of a company called Forever 21? That's a company that did really well, but it didn't stick with fashion trends, and leases were too expensive. But this company doesn't have the problem with leases, so the only problem it has is fashion trends. As long as it stays up there with fashion trends, that's not a problem. So the problem with Forever 21 was it was expanding too quickly. The leases were expensive. They weren't able to control their costs, and they were kind of falling out of fashion because the problem is once you get too big, kind of everyone's kind of wearing the same thing after a while. If you get what I mean, if like if this company starts producing 1 to 2 billion or even 3 billion revenue, you're either gonna have like a lot more designs, or you're going to be selling a lot more of the same design. So when you start selling a lot more of the same design, a lot of people are going to be wearing the same thing. Then you just fall out of favor because, like, everyone wants to be unique. They don't want to be wearing. They don't want to be clashing, especially since the target market is more females for this company. Then they're not going to be wanting to wear the same thing, of course. So I kind of see fashion as being it has its upside, but it also has this, it has that downside. So for me, I'd rather buy this company when the price is actually lower. I don't see the upside being too much of an upside unless there's a bit more hype built into the stock and the market just takes it for a ride. But for me, unless this price kind of fell a bit more to give me that upside of 50% in 2 years, I wouldn't say I was like very confident. Like the 50% for the stock is possible in 2 years, but that's like going for the very upside, and I don't like to just be like, oh, my upside maximum 50%. It has to be standard upside, like, yeah. But I mean, that's just me, of course. You could well have a different view about this company, and also you could be using this company and you feel like this is the company that is doing great stuff, and they could have a secret strategy just hidden that's gonna really boost their growth. But if their growth is gonna be around 22%, and their net profits are gonna be growing around that same mark, as I say, your net profits should be growing quicker than your revenues. Like, it's arguable that they could be trying to grow this company quicker, so they're spending more money on marketing, but so far their marketing is pretty consistent with their growth. They're about 22% spend on marketing increase, and revenue same. So I don't see anything that's out of ordinary that they've been doing. So I think these numbers are expected. They look pretty consistent. Nothing out of the ordinary that they've been trying to do. So for me, I don't see this company as being like a great buy. But I mean, if you want to buy something that's going to give you a decent, fairly standard return, maybe this isn't too bad. Buying it, I don't see it for me as a really high growth company or anything like that, even though it's kind of like this pioneering a good strategy in like retail and online. So yeah, like, let me know what you think, and like, if this is a company that interests you, what kind of upside do you see that I'm not seeing? But for me, I'm not rushing to be an investor at this kind of share price or this kind of valuation. Maybe if it dropped to 1 billion, which would be quite a bit actually, be quite a bit. It literally would be about that $14 mark that I would be considering buying, or maybe 17. But I don't think I can justify this price tag, and consider that there's a big upside. Like, the upside's just not big enough for me to want to buy this stock. But I hope this kind of gives you a bit more information. And for me, it's always fun looking at these companies and making comparisons, because if you don't make a lot of comparisons, you don't actually know what's good, what's bad. So definitely hope you found this informative, and until next time, good luck investing.